Welcome back to Bazaar Morning Call. Well, for now, Anuj is joining in to give us a quick trade setup. Anuj, before that, we were discussing what happened with the game yesterday. Fabulous upset there by Saudi Arabia. So, big game today as well. Who are you rooting for?
Yeah, but, and Saudi Arabia has declared national holiday. So I'm hoping someday, we'll also get national holiday if we if we do something.
If we win.
If we win. If we qualify for the Football World Cup, maybe. More than that, did you see the clip which went viral about with that Arabic commentary?
Yes.
I think you should see that. I think this just... sometimes, I feel that, one day we should be able to anchor, like that. And, just with that much energy and just go out and just, shout and all.
Nifty.
Yeah, and all-time high, just go out and...
We tried that once with t-shirts, Anuj.
Let's not get there. Yeah, so let's get back to markets then. Okay, so look, very clearly there's clear signs of a fresh breakout. The only thing is that this is towards the year end and volumes are very low. So the markets will give you some false breakout and false breakdown signs as well. But then, that's something that traders have to take into account. And what the market will do today is try to preempt the US Fed minutes, because Fed minutes come out tonight and US itself is not trading tomorrow, we are. So in that sense, it's going to be very important. Tomorrow's expiry and the market will react to that. But as you can see, the data is clearly suggesting that the rate hike expectations are lower now, 50 basis points perhaps in December. In terms of Indian trade setup, what happened yesterday was that the market bounced once again from that put call ratio of 0.75 thereabout, and it's now gone up to 0.99, which is still again in a bit of an oversold zone. So maybe there's space for markets to go up. The base now has moved up to the rising 20-day moving average, which is at 18,113. And for starters, if after the gap up, the level to watch is the 10-day exponential moving average, which is at 18,234. And there's big breakout if you start to trade above 18,360, going by the options data and the 18,300 call writers. And the bank Nifty straight away opens at all-time high, which is 42,623, which will be interesting if there's some profit taking there, because above that, 42,650 becomes a crucial level to watch. Above that, there's a big breakout. But as I said, volumes are low, so whatever trading decisions you take, keep in mind that markets can move as well on the opposite side very quickly. So that would be a bit of a risk factor.
All right, Anuj, thanks very much for that. Will it be one of those cases? And as always happens, markets do the most expected, obvious thing in the most unexpected way. It's entirely possible. You have to be open to the idea, because the basic trajectory has been higher, right, all through this year. So will that completely suddenly reverse and change as we enter into the year? It's unlikely. It does not happen. A big reversal, a new trend beginning this late into the year is usually unlikely. So we'll see. Deven, of course, is still with us. Deven, I was just looking at, Max Financial Services. I don't know if you have a view there. But if you do, this is an absolute disaster, right? Yesterday's volumes on Max Financial were the highest since middle of 2020. So it's going down on pretty large volumes as well, at about 650 now. Any thoughts here? Max Financial Services.
Prashant, very great. I think I'm not keeping track of this company.
Okay, let me, for our viewers, if we can have the intraday, I'll tell you what seems to be one of the worries. One of the worries seems to be what's going to happen with the Max Axis deal. Will Axis be allowed to buy the remaining portion of what it said it'll buy in Max Life at the earlier rate or not? Our colleague Yash has reported that the IRDA has raised issues, the prices, the varied prices at which the transaction was done, etc. That seems to be the latest worry, apart from any worries on the business front, etc. But it's not particularly particularly bad as compared to other insurers. So one assumes it's not just business, but it is something else as well, which is worrying. I think from 900, 950, where it was for a long time, it's dropped to about 600, closer to 600 at this point in time. The pre-open rates are, by the way, coming up. The first, and they'll take some time to settle, but they're up 100 points on the Nifty, and it's a solid start once again on the Sensex as well. Rupee is opening at 81.80, and it's slightly weaker as compared to yesterday's close. Sonia.
Are you just want to point out a couple of more stocks, right? And we'll talk about that in greater detail. But Maruti Suzuki is the top gainer right now, up almost about 1.5%. There is a positive UBS note, and I'll bring that about in just a bit. But apart from that as well, just keep an eye out on LTI Mindtree. Citi came out with a note where they say that they resume a sell with a target price of 45.10 on LTI Mindtree. And they say that employee attrition, if any, is something that you need to keenly watch out for. And the integration, the progress on the integration is something that needs to be tracked closely as well. So just a couple of stocks that you need to look at on your radar. Well, the Petroleum and Natural Gas Regulatory Board has issued notifications on the natural gas pipeline tariff regulations, which became effective on November 18th. To discuss how these would impact the key natural gas players, we're joined by Prabal Sen, the energy analyst at ICICI Securities. Prabal, thanks a lot for joining in. First, if you can just explain to us, your thoughts on the new pipeline tariff rules, and what could the impact be on this for the industry and for the individual companies?
Well, I think broadly speaking, it is fairly positive if you look at it. The series of moves that have been done. Just to quickly summarize some of the key measures, the ramp up of volumes, which is essentially the nominal volumes that are considered for tariff, that period used to be 5 years. That has been extended to 10 years. And in our country, where where utilization of gas pipelines is anyways running at less than 50%, if you look at it on an aggregate, that is a positive move that allows the companies to sort of spread out the tariff over a longer period, and that is one big move. Secondly, system use charges, some additional costs have been allowed. Thirdly, for capacity expansion for new gas sources, there has been a 5-year holiday that's been given in terms of applicability of tariff. That's very significant, particularly for GSPL, which does have a lot of pipelines that will be connected to some upcoming new LNG terminals, for example. And for them to basically get that leeway while the terminal ramps up, I think that will be a crucial positive. Similarly, there have been other moves in terms of the lower tax rate applicability, which will happen now prospectively from FY24 instead of retrospectively, as was being feared earlier. Broadly speaking, there was an apprehension that tariffs would get severely cut specifically for GSPL to the extent of even 15 to 20%. I think that fear has largely been taken care of. Our rough cut estimates suggest it would probably be less than 10%, if not lower now. And, and it also sort of allows the newer pipelines and expansion pipeline to, sort of get set up without the fear of being penalized on the tariff front.
Okay.
So it's a fairly aggressive and a fairly reformist measure by the board.
Okay. Hi, Prabal. Thanks so much for detailing that to us. There'll be an annual escalation now in tariff on an annual basis. Earlier, I think it was 4-5 years odd. What's the formula they'll adopt, and what are you factoring in?
Well, I think, frankly, we'll have to see the modalities in terms of how that actually plays out of the ground. But on as a principle, having a much more dynamic tariff fixation mechanism is very relevant because of the way that demand and volumes have been very, volatile. If you think about, what has happened, particularly for GAIL, where utilization of their older pipelines is probably still okay for the HVJ and UPL, but on an aggregate basis, their utilization is at 50%. The nominal volumes that were fixed earlier, for example, were at 100% of capacity. And therefore, you can have a 5-year period where you're literally getting underpaid and you're underutilizing, and that shows up in your return ratios. So the fixation on an annualized basis can probably at least correct it to the extent that you can. And I think that's a very, very positive move. Okay. How the methodology would be, I don't think the methodology would change much. It's just going to be on a 1-yearly basis and adjust for, changes in actual volumes and so on and so forth.
But in terms of a timeline, what are you penciling in? When will the next tariff change come in from?
Well, I think the documents and the amendments themselves state that, the applicability will be from the 1st of April, the uniform tariff, and these regulations, the pending tariff order should be in place by the end of this financial year. So even if it happens sometime in FY24, the applicability of these orders and the amendments will be essentially from the beginning of FY24. That's what we understand.
Okay, all right. Prabal, do you think that this change will take care of the commoditized segments of GAIL, like marketing, petchem, etc.?
No. I think this is purely a measure for the transmission segment.
Yeah.
And therefore, the impact of earnings or, as and when they get revised, as and when we get the tariff orders, will be more significant for GSPL. because they had a lot of more pending issues with respect to expansions and new pipelines. GAIL obviously benefits because transmission tariffs do get adjusted upwards, hopefully, but the overall impact on the stock should be minimal, is what our sense is right now.
Okay, Prabal, since we have you, your thoughts on, good morning, Reliance, how things are set up there? And
I think
a quick, quick word on upstream, ONGC, etc. as well. Yeah.
Well, we don't, I mean, for Reliance, I think very clearly the OTC segment earnings are looking better from a Q3 perspective. I think the margin profile, which, after the weak results of Q2, our sense is that the strong diesel spreads and the strong ATF spreads should actually deliver a, much better OTC segment, result. And therefore, overall EBITDA should actually be up, sharply over the lows that we saw in Q2. So from that perspective, I think, the prospects look better. As always, with Reliance, earnings growth is one part of the story, and the longer term prospects from green energy and the new energy prospects, those remain the key triggers. And as we go along in this year as well as the next, I would say that those will be the crucial monitorables to look at. But from an earnings perspective, I would say Q2 does seem to be a bottoming out quarter, and things should look better from here. Okay. For ONGC, I think the people have pointed to the crude softness as a bit of a bearish indicator, but our sense very clearly is, given the adjustments that are being made to the windfall tax, in any case, their net realizations are capped at $75, and $75 is still a much stronger number than what they have done if you look at the average over the last decade from an oil realization perspective. And as far as gas pricing is concerned, even if the Kirit Parikh committee, as is expected, declares a slightly softer gas cost environment from the current levels of 8.6, anything over 6.5 is still fairly lucrative, at least for their legacy assets. And for the newer KG Basin asset, they would probably anyways get a premium gas price, which should be closer to a long-term contracted LNG prices, somewhere with some discount here or there. So, from an earnings perspective, I think ONGC does look good. Valuations are extremely attractive at less than 3 times consolidated earnings. So I would be a very, very positive at these levels on the name.
All right, we'll leave it at that. Thanks a lot for joining in, Prabal, and have a great day. By the way, the stock of the moment on the downside is Nykaa, down 3.5% now after those multiple resignations and the resignation of the CFO recently as well. So Nykaa is under a lot of pressure. Zomato is down about 0.7%. But other than that, it's a good-looking screen, you'd have to say. The Nifty is up about 80-odd points, led firmly by Maruti Suzuki, Hindalco, the HDFC twins, HDFC Bank, HDFC, and a lot of the other banks like Indices and Kotak. So we'll talk about some of those stocks. Sudarshan is with us. Sudarshan, what's the big call at 9:10 this morning?
Well, for the Nifty, it's to maintain your long positions and keep a stop loss, and buy IDFC First Bank with a stop under 54.
Okay, all right. Thanks, Sudarshan, for that. We'll catch up with you later today. Mitesh, what about you? 9:10 call?
I'll go with the buy on IndusInd Bank. Keep a stop below 11.55 here. Look for a target of 1200 to begin with.
All right. Thanks very much, gentlemen. Those are 9-10 calls coming through. Z is at the bottom of your screen as well. In the pre-open, it's up about 0.75%. Vaishta is here to tell us more on that name. Vaishta, hi. Morning.
Hi, Prashant. Good morning. Well, TRAI had announced the implementation of the new tariff order 2.0 yesterday. And as per the earlier new tariff order 2.0 version, the pricing on the channels which are forming a part of the bouquet were capped at 12 rupees, which has now moved up and gone up to 19 rupees. Also, as per the earlier NTO 2.0 version, there was a capping on the discount of 33% for bouquet prices versus the sum of a la carte. But as per the new tariff order, the broadcasters are now allowed to offer 45% discount. So now we have to wait for the implementation of the new tariff order, which will take place by February 2023, and the channel pricing list, which is required to be submitted by the 1st of Jan 2023. Nuvama feels that the new tariff order 2.0 implementation is positive for all broadcasters. Also, their view on Z is that they expect a good recovery on the ad revenues due to the improving gross margins for consumer companies. So net seems positive for the broadcasters, as the subscription revenues now have the potential to improve, especially in the ongoing weak advertising environment. Also, we recall that Zee's advertising revenues had fallen by 7% in the past quarter, and the subscription revenues were modestly up by 4%. So the new tariff order 2.0 implementation will be a key for names like Zee.
Okay, thanks a lot for that. Well, Lupin is also in focus this morning. Ekta is here to tell us more about that. Ekta, over to you.
Thanks. Well, there is a buy report which is coming from Citi with a target price where they've raised it to 840 rupees for Lupin. Now, according to them, if Spiriva generic, which is basically one of the products in their portfolio, which is expected to be launched, it is an inhaler. If in case it is approved, Lupin is expected to enjoy sole exclusivity in this particular drug in a $500 to $700 million market in the next couple of years. So they are positive on the Spiriva generic opportunity. The product has potential to repair margins from a sub 10%, which Lupin has been reporting, to 17 to 18% as well. Now, if in case the approval is delayed following additional queries from the US FDA at this point in time for Spiriva generic, they believe the downside is in fact limited, as there is a strong flu season in the US, and the impact of another drug which is used for bowel conditions called Suprep generic can help in terms of margins in Q3.
Okay, thanks a lot for that. Well, the other stock that we are watching this morning is Maruti, and I'll tell you why. There's a very interesting report that has come out from UBS on Maruti. They have a buy call with a target price of 12,000 rupees. Now, they say that there is a complete focus away from diesel cars, and the biggest winner due to this is Maruti. Now, the real-world driving emission norms will go live from April 2023, and there are stringent norms on diesel cars that will increase the relative cost of diesel cars in India. And if the cost of diesel cars goes up, then people will perhaps move more towards petrol cars, EVs, CNG, etc. And Maruti as a company has zero exposure to diesel. So the shift away from diesel is perhaps going to be a big positive for Maruti. That is UBS's base case, and hence they are going with a 12,000 rupee target price over there. In fact, Mitesh, very quickly, if you can give us a chart check on Maruti now.
See, the stock was actually doing very well when it went to about 9,600 plus levels. Since then, it's corrected and, kind of dropped out of the uptrend, but it's near the support areas of 8,600 to about 8,700 zone, which are long-term supports for the stock now that the chart has made a fresh high. So I think from these levels, if it starts bouncing back, the first target would be around 9,200. Beyond that, I think it'll catch good uptrend.
Okay, all right, Mitesh, thanks a lot for that. By the way, just keep an eye on a couple of stocks. Hindustan Zinc, it appears that the stock is lower, but I think that's adjusted for the dividend payout. Yeah, it's gone ex-dividend today, so that's why, in fact, now that's appearing that it's 5% down, but it's the interim dividend of around 15 rupees 50 paise perfectly ties in with that. So actually, the stock is as flat as can be. Zee was a stock that we are looking at, so let's see what happens out there. For the time being, it was up only around 0.5% odd, and a couple of other notable names like Max Financial. Well, that's opened up with another cut of around 3%. Some fund-based selling is what we saw yesterday. 50
lakh shares sold by Catalyst, so that's been under pressure. Max Financial, it's the big loser. Max and ICA are the two big losers that you can perhaps look at this morning. Apart from that, the positive global cues is something that could perhaps lead the Nifty to break out of that range. 18,325 is what the pre-opening rates are suggesting as of now. In just a couple of seconds from now, you'll have the first opening on the index. The Nifty is up almost 80 points, 70 points now. The Sensex is up 200 points, so good opening to trade this morning. Hindalco is your top gainer, up about 1.5%, followed by a lot of IT names. Wipro, Tech Mahindra are in the green, up about 0.6%. You have HDFC that's leading from the front as well. Maruti, Eicher, M&M are a couple of other names that are up about 0.5 to 1%. Followed by that, you have the Bank Nifty, by the way, is up about 150 points, so looking good there. It's led by Kotak Mahindra Bank. You have HDFC Bank and a couple of others that are in the green. SBI is also holding up, actually, up about 0.5%. No stocks in the red except BPCL from the frontliners, which is just barely a tad bit in the red. It's green on green for the markets this morning. The Nifty inching towards that 18,300 mark. Better action yet in the broader markets today.
Well, that's right, Sonia. For the time being, at least, the broader markets are doing better. NBCC, well, that's the one from the F&O pack that's doing the best. It's up a mild 2.5% odd. They've charted out expansion plans. They're looking at securing orders worth around 6,500 crores, and they're also looking into foray into the foreign market. So it seems the street likes that. A couple of newspaper reports are indicating that. Siemens, well, in reaction to its weak numbers, let's see what's the reaction we're getting on the stock. That should have opened up. In fact, it's up closer around, it's down closer around 2% as we speak. A couple of other ones. Vedanta, well, that opened higher. Let's see what it's doing. Good dividend is what they're paying out, 17 rupees 50 paise. Nykaa, resignations continue, supply overhang as well. Well, that one's opened up with a cut of closer around 2.5%. Adani Enterprises, they're going to be raising some money, so that opened up mildly higher. It had a bit of a run-up in the last couple of days, very, very mildly higher. Aether, they have signed a long-term master service agreement for research and manufacturing, so that one should be a little bit excited. For the time being, it's down 1%. And DCW, a stock we don't talk about too much. They're doubling their CPVC capacity by another 10,000 units. So that one locked in upper circle with a gain of around 5%.
All right, Nigel, 60 points, by the way, so this is looking pretty decent. 18,300 at the word go. It's responding to the pretty brisk kind of rebound we had in risk assets overnight. And of course, in a way, also following through after yesterday's pullback that we had in the last 45 minutes of trade. By the way, a few other names. Mazgaon is up 2.5%. It kind of continues where it left off yesterday. Mazgaon saw a huge recovery yesterday. Sun TV is about 1.5% higher at about 495, coming up with decent volumes. Data Patterns is another one, which is up 2.7%. Volumes are lacking, but I mean, for this point in the day at start, this is what's coming up right on top. NBCC is up 2.25%. AstraZeneca is up about 4%. DCB Bank, we already mentioned. Bector Foods is starting about 2.25% higher as well. On the downside in the broader markets, Nykaa, we already mentioned, down another 3%. Ease My Trip saw this huge move yesterday. We had the management with us in the morning. Stock, I think, ended some 13-14% in the green. It's down 4%, so some pullback there. I was talking about Max Financial Services. I mean, that is down and out. I mean, 1.25% down to about 637 now this morning. And yesterday's volumes was some of the highest we've seen in the last 2-3 years. What else? I mean, I'm seeing the first signs of some pullback in PSU banks after many days of outperformance. So UCO is down 2.5%, Union is down 2%, Bank of India is down 1.5% as well. So this is broadly the picture as far as the markets are concerned in the broader space. Nifty has got 56, 57 points on it at about 18,300. Our market master of the day is with us. He's Nilesh Shah, Managing Director and Chief Executive Officer at Envision Capital. Nilesh, it's always a pleasure welcoming you here in the studios. Thank you very much.
Thank you. Thank you so much, Prashant.
How are things looking? Is the worst behind for global markets? Because I mean, we didn't see very much of the worst here, at least on an index level. There's been great outperformance. But is it looking a little more constructive as we wrap this year up?
Oh, absolutely. I think it's heartening to know that we've had a strong pullback from the lows that we saw in the middle of the year. It looks like there are a lot of concerns around inflation and growth seem to be now kind of finally ebbing. And it looks like that we're set for a good kind of the next 1 year or so from here onwards.
Okay, that's a great way to start the interview, Nilesh. Always a pleasure speaking to you here. I wanted your thoughts on a sector that you've tracked for so long, right? IT, because now the valuations are looking a bit compelling and there's a cycle that every sector goes through. You think the worst of the down cycle in IT is now behind us?
Absolutely. Clearly believe that the lows that we've seen in 22, I don't think we're going to revisit those lows. What it looks like, I think, is from the kind of layoffs that we are seeing in the United States. Finally, the indirect fallout of that is going to be essentially a better environment for hiring, better environment for wage costs. That, in a way, will provide a strong cushion to the margins of IT companies. While growth for the next 3 to 4 quarters could still be on the lower side of the range, but I think that's probably going to be a more transient kind of a phase. And maybe 2 or 3 quarters from now, you will see again, IT come back very, very strongly. And like what you said, I think the valuations are very, very attractive. So you're going to see a combination of growth coming back, margins coming back, and then, of course, valuations being attractive, perfect for growth investing.
All right. Hi, Nilesh. Good to have you in the studio and meet you in person as well after a while. Well, what about the new age themes? Someone thought that there was value a few years ago, in the pre-IPO round. And some of these stocks are way below, one of the first few rounds as well. Some of these themes, they could become attractive at some point of time. But when? How much more downside are you assuming? For the notable names that are getting a hard knock is Nykaa as well as Paytm. Nykaa, everyone was gung-ho, I remember. suddenly things have turned around. That corporate action hasn't worked in their favor. Now these resignations. So what's your take?
Well, clearly, of course, the fraud that we saw on pre-IPO or IPO or even post-listing, that is kind of completely gone out.
Yeah.
Some of them have essentially mended their business models to ensure or guide for a path to profitability. So that's like kind of heartening. A couple of them continue to deliver very strongly on growth. And that, again, I think is great news. Unfortunately, a few of them have essentially not indulged in the best of kind of corporate practices. And that's taking a toll. But having said that now, what it looks like is that the valuations are attractive, especially for a long-term investor. I honestly don't know how these will behave over the next few quarters. Yeah. But if you have maybe a 2 to 3 year kind of outlook, I wouldn't be surprised if these end up delivering some solid returns. Not all of them, but maybe just to select 1 or 2 out of them. Currently, in the very short term, the pressure from essentially the investors who came in the IPO or pre-IPO, I think that pressure will continue because they all need to book some profits or whatever profits are left out there for them by the year end. They all need to basically shore up their P&Ls and all of that. These are global investors. I think once that passes, I clearly believe that I wouldn't be surprised if 23 we see some fair bit of outperformance from this pack.
Among them, which one would be top of the list for you?
So the one that we own, I think, is PB Fintech. They have essentially demonstrated strong growth. They no longer are having any cash burns.
Yes.
They get basically adjusted EBITDA break-even by Q4 of this year, and they've guided for reporting accounting profits next year. Leadership continues, 90% plus market share. A bit of the environmental or the regulatory risk remains in terms of how Bima Sugam will play out and what it means for their economics. But otherwise, I think that seems to be a kind of a great name. They have been able to manage competitive intensity relatively well. So that's probably a standout one among the entire kind of pack.
But that Bima Sugam could be a big one, right?
Yes, that's the big overhang.
That kind of straight away attacks the commission structure for companies like aggregators, basically.
Yes, the only thing, Prashant, is we really don't know how long that will take to play out, what it will actually imply, how does that change the terms of the trade, how that change the competitive landscape. One has to see. I think at times what we also think is that every initiative will become like an UPI initiative and will disrupt everybody. May not. The reality is that insurance business requires a lot of hand-holding. And I'm not too sure whether entirely having a monolith or a monoline model of just online will help or not. Keep in mind that even Policy Bazaar had to gravitate towards also the offline or the physical model because you need the agents out there to help you while you're claiming your health insurance, your life insurance, all of that. So you need that support system. So I'm not entirely sure why I don't rule out the impact of that, but we'll have to see how that plays out.
The price is already significantly correct.
Oh, absolutely. I mean, look at the current market cap, 16,000 crores. Basically, if you split it between the two, Policy Bazaar, Paisa Bazaar, 8,000 crores, 8,000 crores. That's $1 billion each for a unicorn. I'm quite sure as a private investor, if you were approached, you would happily kind of give it the status of a unicorn for both the two pieces. So maybe that's one way of looking at it. And then, of course, if you look at the kind of 3 to 4 year guidance which they have dished out, and if you kind of put some numbers to that, I think there's a lot of value on the table.
So just to add on to the point, I think the supply overhang is relatively less as well out here. That's a sense you get.
Yeah, Nigel, but those are things which are very hard. I mean, we might today say that there's no supply, and this evening we'll probably receive a message saying there's an offloading. So honestly, it's hard to take. But I clearly think that the business leadership is intact. Cash burn is no longer there. There are strong cash flows. And of the 16,000 crores, they have 5,000 to 6,000 crores of cash. I don't remember the exact number. So you're talking of a number which is way lower, and probably they've talked about that a year from now, they'll start probably thinking about paying back cash to shareholders. I don't think there's any other new age company which is thinking like that. So for me, that's why that's probably a standout name amongst that pack.
What about Nykaa? Because, over there as well, right? I mean, the stock has halved this year, but the business model is still strong. They have a dominant market leadership in the space. There's a first mover advantage. They are profitable, and the earnings as well, the recent quarter earnings were not too bad. There was a pickup there. So is this also in one of your lists of, buying stocks at good value?
It's there on the radar, it's there on the horizon, but I'm not too sure that it's made it to the buying list. That's because I think the competitive intensity is kind of going to go up for them. There are two areas. One is the core business. You're going to witness more competitive intensity as the bigger names essentially up the ante and kind of, bring about a lot of competitive pressure. So that's one. The second side of it is that, of course, the adjacency that they are addressing, which is the fashion business. One has to see again, that's again a competitive segment, and how that will play out, what it means, what are the incremental investments that they will have to make over the next maybe a year or two to build the critical mass. These are some of the things which we will have to be kind of watchful about. I think if they pass this hurdle, it's quite possible that also ends up being a nice, good long-term investment.
Okay, so that's on Nykaa. But where else do you see, alpha generation now? I mean, you were speaking about how IT could be a very good play over the next couple of months as you look at buying growth stocks, right? Where else?
Clearly, this time around, or probably over the short to medium term, growth is going to be in a lot of manufacturing-oriented sectors. I mean, of course, defense has played out well. The product guys in capital goods segment, I think that segment is kind of doing well. Order books are still kind of holding up. For some of them, they are swelling, so that gives a lot of visibility. Auto components, some of the companies out there, especially the smaller ones, have managed margins really well. And I think if you've been able to hold on to your margins in Q2, it's very likely that you could probably even improve upon your margins for the rest of the financial year, or maybe for the next of the few quarters. So these are some of the manufacturing-oriented pockets, which I think, again, look extremely attractive from a 1 to 2 year perspective.
For all the rise in share prices, P multiples are still 18, 20 times broadly, right? FY24 earnings. Actually, not just Mazgaon, we should put up Cochin and Garden Reach as well. These are three of the top volume-led gainers today. Even as we continue this conversation with Nilesh, Mazgaon, Cochin and Garden Reach. And just one more name is TCNS Brands. I mean, it's a big move on TCNS Brands. There's a news flow. Our colleague Nisha reported that they were looking for M&A activity, looking to sell. The promoters were looking to sell. 7.5 higher on TCNS. That's 600 on the apparel maker at this point in time. Insurance is a space, Nilesh. Do you own anything there? Any views in particular? I mean, I was mentioning Max earlier, where we've seen so much price damage.
So it's again a very exciting kind of space. Probably it's the one which has probably the best longevity in terms of a business opportunity. But I think we're basically veering down to a conclusion that it's better to own essentially the distributor, the market aggregator, etc., because you then become agnostic to whose insurance policy sells. Finally, what matters is the policy selling. Doesn't matter whose policy sells. And I think from that perspective, PB Fintech or Policy Bazaar is a great proxy for the insurance space. But having said that, I think the top 2 or 3 insurance companies will also do well over the long term. I think, of course, valuations are a bit challenging for them, and a bit of the movement in terms of bond yields and all of that does impact their profits in the very short term. But otherwise, I think from a structural perspective, these are great investments to kind of bet on.
Okay, all right. And, my colleague Sonal, she says that it's around 5,100 crores in terms of their cash as of March. That's on PB Fintech. What about the pharma space, Nilesh? The headwinds continue on pricing in the US, but the hope is that at some point of time this will wear out. And maybe 2023, finally things can start looking up. On the pricing aspect, maybe it will not be such a big erosion. Your take on the space?
Nigel, I think that's probably been the most disappointing kind of sector in terms of performance, especially from if we were to kind of look at the COVID environment and where we all thought that over the next few years, pharma is going to be a standout sector, and that has unfortunately not played out that way. And I don't see yet any kind of silver lining out there in terms of, the pricing. I think it's still a hope trade that, too much of the pricing erosion has happened and all of that. But I still think overhang in terms of pricing, in terms of regulatory stuff, in terms of margins, they still kind of continue to kind of be there. The reality is that there are, way many more number of other opportunities, many more other sectors which are today firing or at least are expected to do much, much better, especially on a risk-adjusted basis. So I'm not too sure whether pharma, it's not gone anywhere, but I don't think it will go anywhere.
Okay. Give us some ideas. I mean, the end of the year, right? So generally when it's Diwali, when it's New Year, we ask for some ideas for the next year. What are you looking at? You spoke about themes, but tell us about stocks.
No, I think clearly next year, I would probably think that some of the IT companies could do well. We've been owning L&T Technology Services for a while now. And if you look at the latest earnings call, where they have basically said that they've hit $1 billion run rate. And by FY25, they expect to hit a run rate of $1.5 billion. That's like a kind of a 50% increase in revenues over the next 2 years. I mean, I can't think of any other meaningful IT company kind of growing at that rate, especially in this kind of an environment. So that kind of looks pretty good. Some of the offbeat financials look good, be it the tier 2 banks. be it some of the mutual fund distributors, some of the online brokerages. I think that to me still continues to be a...
name 3 names there?
We own Angel. I think it's one of the ones from the 2020 IPO, which we've been owning it post its IPO listing.
Okay.
Done well. The business continues to kind of perform really, really strongly. A bit of the regulatory overhang is there in terms of, would there be caps in terms of derivatives, F&O, but those are all very standard business risks. But I think the business continues to execute really well. One area which I think could probably be again a standout for 2023 is the packaged food segment. They all have the margins have got crushed under high, raw material prices and freight and packaging costs and all of that. They all have responded by taking price hikes and doing grammage alterations and all of that. What we own out there is Mrs. Bector. I think they had a stellar quarter. The first half had fantastic revenue growth. Expect some bit of the revenue growth to sustain, margins to come back. The other name that we continue to like in this space is Pratap Snacks. I think it's attractive. Margins completely beaten down, but they have guided for almost a double-digit margin, which I think could be very meaningful for their earnings. The third, of course, we continue to like is the alcoholic beverages space. I think Radico Khaitan is doing brilliantly out there. They're kind of undergoing major capex. Margins are subdued, but I think 4 quarters, 6 quarters out there, margins coming back, capex completely executed, significant de-risking in terms of raw material sourcing, and of course they continue to grow. I mean, you have a business which is growing at 20-25% for the prestige and above segment. Hard to find businesses in the consumer space growing at that pace.
What about these QSR companies? I mean, since you were talking about management interviews, we interviewed Westlife recently, and they are so optimistic. They're opening, stores left, right, and center. What about like the Devyanis, the Jubilant Foods of the world?
Sonia, great. I mean, of course, these are going to have long-term potential, but just 2 or 3 things. I mean, I think the black swan events can always be lurking around there. I mean, suddenly the principal, the parent doesn't like you, saying, okay, fine, I don't want to have you as a franchisee. That's a huge black swan event. Suddenly they'll up the royalties and that will impact your margins. Third, capital intensity. I mean, you need to keep opening stores and you need to keep investing in these stores. And finally, valuations. I don't think valuations are too attractive. They don't give you, comfort from that point of view. So yes, growth, but I'm not sure if the price is reasonable.
Always good chatting with you, Nilesh. Thanks so much for coming down. Wishing you a good day and good trading session ahead. Look forward to having you in the studio.
Thank you so much.
Yet again. Well, let's move on then. A bit of a boost came in for the ferrous as well as, the stainless steel players with the duties, export duties that were earlier levied. Well, they were pulled back last week. To discuss how does it benefit the stainless steel players, and we have 2 listed players out there, JSL Stainless and JSL Stainless Hisar, which are going to be merged in the coming few months. We are joined by Mr. Vijay Sharma, the director of Jindal Stainless. Hi, Mr. Sharma. Good morning. Thanks so much for joining in. Well, for the past quarter, both these 2 companies that are listed, the contribution from exports was only around 5 to around 8%. But that number is likely to go up, right? Since there is some relief coming in. So could you tell us how much of a relief could it be? What could this export contribution go up to? And does that mean you change your volume guidance? Earlier, you all were talking about a flattish number for FY23. Do you want to up that a little bit?
Good morning, Namaskar. Thanks to CNBC. Yes, regarding the exports withdrawal, the duties withdrawal, we and industry really welcome this consideration by the central government. We are thankful and grateful. You would have known that our strategy, there is a philosophy behind the domestic and exports. Domestic is our passion and exports is the strategy. And there is always a lead time for the supply chain alignment and reorganization from the customer perspective and conversion of the orders to the sales. So this will take a couple of months. So this financial year, the exports volume impact post this duty withdrawal is likely to be seen in February or March. So the volumes, our earlier guidance of having the flat as compared to the FY22 are likely to remain same. And regarding your question about the export mix, you would have noticed that pre-COVID, we were at about stable around 20%. During COVID, there were fluctuations because of the factors known to all of us, where we even reached up to 30. And of course, post-export duty, it was down to 5. So in HY, in financial year 23, the numbers will remain the similar because the impact is going to be in the year end. And in FY24, it is a little early to say about that because you know that our products are going into the extreme high-end value-added niche markets. So we always try to get share out of that. and we will be having reasonable numbers.
Okay, all right. Reasonable numbers, Mr. Sharma. So you're saying the positive impact of this will mostly come towards the end of this fiscal. So the benefit comes then in FY24. So what kind of a growth are you looking at then in terms of volumes for FY24, given that you have additional capacity as well that will be coming on stream? So a volume growth now could look quite substantial. Export avenue opens up. You have an expansion that's coming on stream. Give us a rough number out there. And just to confirm, exports will go back to around 25% of the mix in FY24, right? What you were doing earlier.
Like I said, that export duty imposition was also very sudden, and withdrawal is also very sudden, though very happy with that. So we are working on it and aligning it with the first priority being domestic market. And of course, exports is strategic, and we will work on the numbers. And it is going to be reasonable numbers, like we have been exporting a very in a stable and very as a reliable and a consistent partner.
Okay. I think at the end of the day, Mr. Sharma, it all boils down to whether you can eke out better profitability, right? So your EBITDA per ton, you have guided for around 18,000 earlier. Is there a possibility of improving it further, either in this fiscal or next?
We are confident that we will be able to maintain it despite of the global certainties, what we saw these days, a little cooling down and so many geopolitical challenges happening around the world. But in domestic, there is a stability in the volume. So we'll be able to maintain the earlier guidance of 18,000 rupees per ton.
Sharma, Sonia was referring to, do you want to up it? Since things are going to look up from here on, 18,000 at least is what you could do. But is there a possibility that you could increase it? And also, I need to probe you once on the volume number. For FY24, give us a broad range. 20-25%? Is that something we could work with? Or will it be more? Because you have so much more capacity that's coming on stream also. It should be ideally be more. Go ahead.
Well, you know that capacity always comes in block. Growth happens in degrees. There, the exports becomes a very strategic, important aspect of the total business. Yes, we will, because our customers, which we have been able to develop over the last 20 years, they are more excited about the export duty withdrawal. So we are very hopeful that we will be able to get reasonable good numbers in the right time frame and with not much longer lead time in stabilizing the total supply chain.
Okay, maybe that's what your shareholders are factoring in as well, reasonably good numbers, because, you know, the stock has had a fairly strong run over the last 6 months or so. I want to understand that the debt on the group level, has it peaked out, or do you think that you could see more debt in the near future? Can you give us some numbers as well?
Okay, our overall debt has been reduced by about 40% in the last 2 years or so. But like you already know that we are in the expansion mode. So it all is more relevant points are the ratios, where perhaps today we are at even the better than the industry norms, and we will be maintaining the ratios at a good level.
But what about the absolute number, sir? You
absolute number in H1 and our absolute debt was about 2,750 crores.
Will this number go up because you have a small acquisition as well that you all have done? So the consolidated debt goes to what level? We're looking at it as if it's a merged entity. So give us a sense.
Yeah, this is the merged pro forma debt level of about 2,750 crores.
But it will go up. It will go up because you will be doing one small acquisition, right? JUSL will be coming in your books.
JUSL acquisition, which is likely to happen within this financial year, will add about 2,000 crore debt to this number.
So then it goes to 4,700 crores approximately?
Yeah.
Including that. All right. And also, since we're talking about the merger, what's the update? You had an NCLT hearing, right, on November 11th. And the street is waiting by to hear, Mr. Sharma. Is it happening? Is it not happening? It's been postponed quite a lot. I mean, some of these regulatory things take quite a bit of time. But what's the update?
The shareholders and the creditors' approval was obtained in April. The second motion hearing with the Honorable NCLT Chandigarh happened in July 2022. They had asked for certain information which we have submitted, and the next hearing is in December 22, rather exactly on December 22nd, 2022. We are very hopeful that the merger will happen within this financial year.
Okay, within this financial year. Finally, one word on demand. The trends, how are they looking now? And which are the segments in domestic demand? Where are you seeing maximum traction?
Stainless steel, I think we are in the right business. Number one, if I see the CAGR of the last 40 years worldwide, the top 5 metals which compete with each other, the average of these 5 metals had been 2.5%, wherein the stainless at the highest at 5.5. And if I compare it with the Indian stainless steel growth, it is very closely linked with the GDP growth of our country, and it has been about 8 to 9%. Of course, I would like to avoid that COVID period. Today, apart from the traditional applications, whether it is automobile, railway, transport, process industry, architecture, building, construction, consumer durables, and household goods, they are going strong. Yes, sometimes once in a while, 1 or 2 segments can have a little bit of ups and downs. But the another important point is the way the government has taken initiatives on the economy, whether it is the infrastructure or it is the manufacturing focus. We are very upbeat that the applications, the upcoming applications, not only related to green, even the blue economy also, agri-related, healthcare-related, nuclear, defense. These are the areas where traditionally the consumption of stainless steel has been low. But going forward in the midterm and the long term, we are very, very upbeat that stainless steel is going to have a very, very healthy and very, very positive growth rate.
We wish you well, sir. Thanks so much for joining. Just before we let you go, your peak debt number will be 4,700 crores, right?
H1 closing, it was 2,750, and JUSL is likely to add it about 2,000 crores.
Okay, all right. And the next hearing for the mergers in December 2022, and you're still optimistic?
22nd December 2022.
Lovely. All right. Thanks so much, Mr. Sharma, for stopping by, giving us those details. We'll try to probe you more on the volume and the EBITDA number in our next chat. But for the time being, you have told us that, yes, this is the positive and that export avenue opens up yet again.
Nigel, just a quick word on the market. We've got, 37, 38 points now or left, which is, about a 20, 30 odd point drop from where, we were. Just a bunch of other names. I mean, I was talking about the defense names. Karnataka Bank is up 6% now, so that's a big, move. 147 Karnataka. RCF has come out. I mean, it was nowhere in the mix in the morning when we started. It's up 4%. TCNS, of course, I mentioned earlier. That's up full 10%. NBCC also we mentioned earlier. Ujjivan Small Finance Bank is up 5%. West Coast Paper is up about 5%. And you've got RHIM, which we spoke with the management yesterday. It's up another 6% after the strong run that we saw in trade yesterday. So just a bunch of new names. So broader market, stock-specific action, a fair bit going on. We'll take a quick break here. We have the management of Aether Industries joining us next to talk about their long-term master service agreement with Polaroid. Later, we'll also connect with Rahul Gautam of Sheela Foam to discuss their business outlook. Stay with us. Coming back in 2 minutes.